Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 12th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I cannot give financial advice. It's for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, one thing I want to just make clear a couple things here before we get into this week's slides. First of all, I am going to be raising prices for the newsletter. If you are already a subscriber, you will be grandfathered in at whatever price that you came in at. We have people that came in when I first started the newsletter that are at one rate. We raised prices. Those people, if you're a current subscriber, if you choose to resubscribe when your subscription comes up at the end, you'll be grandfathered in. And so I'll be raising the new rate probably September 1st. It's currently $150 a year. I'm probably going to go up to $179. I mean, inflation is a thing. I have costs, and those costs have went up. I have resources that I have to pay for, communications, internet, a lot of other things. I subscribe to a lot of periodicals. So I have a lot of information coming in, websites that I use, tools that I use, and this all costs money. So look forward to that. If you want to beat the price increase that's going to happen September 1st, please go ahead and subscribe now and you'll be grandfathered in. The other thing I want to make clear is there's a reason why I do the videos. There's a couple, I've talked about this before. Just because that I highlight some information or I put a slide up with a graph or a chart, it doesn't necessarily mean that I agree with the conclusion or the information or whatever. I put the stuff up there because this is kind of a weekly market update. It is information that I have seen during the week that I think is pertinent, that I think is interesting, and in some cases that I think is amusing to me. Okay? It doesn't necessarily mean that I endorse the view of an article that I choose to bring to your attention. That's why I try to put links to all the articles that I highlight, because that gives you the opportunity then to go look at it yourself and come to your own conclusion. Okay? I have a view, and you may have a view. If 10 people look at the same piece of information or same article, they're likely to come with several different interpretations or views on that particular piece of information. So it's neither an endorsement, it's not a, that's my view because I highlighted somebody else's view. That's not how it is. Okay, I take in a lot of information, okay, and then I try to come to, as most people would. So I think sometimes there's a mistake to think, well, if you put this article up, and, another thing that we try to do here is this, I'm running a business here. I know people don't understand that. Some people don't understand that. So I put titles to attract eyeballs so that people will become interested in watching my videos and that hopefully at some point transition to become a subscriber. That's how this business works. It's been very successful. Okay. Some people find value in these weekly market updates. Many people don't. Everybody's different. Okay. So this is not like, I'm trying to outsave the world. I'm running a business and I want more subscribers. So over time, hopefully, what many people have told me said that became subscribers is your videos I found informative, or I like them, or I like some of your views. The way that you look at things is similar to the way I look at things. And so that's why I became a subscriber. That's the whole purpose of this. This isn't public radio. I'm not doing public service announcements here. I have a certain view. I have a view that's not mainstream in politics, in religion, and in life. Okay. It's not a mainstream view. So it's not going to be for everyone, and everybody's not going to like it. But there is a subset of people that this will appeal to. Okay. That's why people ask me, how come you don't have more subscribers? Because my views are not appealing to the average person. Okay, that's just how it is. And I'm just an amateur person. I'm on the internet. I've always said this. I'm not a guru. I don't know what's going to happen in the future. Okay, we try to take in, we do, this is what we're doing here. Pattern recognition and establishing probabilities based on history and based on the information that we have. Guess what happens when information changes? Many times opinions and views have to change. That is one of the things that has made me successful in my life. And it took a while to learn that. Not being rigid in a view. If, as Mr. Keynes was said one time, when he was asked why did he change his view on something, he said, well, when the information changes, I change my view, sir. What do you do? So, you know, just wanted to clarify this because I think there's some mistake in what I'm doing here. Okay, I have a business; it's successful. I make no bones about it. Okay, this is not National Public Radio. I believe that anything that's worth doing should be done for a profit. And I also believe if I just give away all the information for free, give my newsletter away for free, people have suggested I do that. Why would I do that? I put a lot of time and effort into it, and I have a lot of resources that go into it. Okay. You don't have to subscribe to it. You can choose to subscribe. You can choose not to. It's a free market. At least it still is. So this is just wanted to clarify that because I think people think, well, I highlight an article that I found interesting or I thought, was amusing or, whatever, provocative in some cases. That doesn't mean that's my view. It just means that I found it interesting and it may have an opposing view. Like last week, I highlighted an article about the fact that one of the banks up in Canada came out with a very interesting research paper about the fact that they think that's possible that substitution and recycling will be able to put a lid on, this big copper supply deficit. I don't just dismiss it outright. I looked at it, I read it, and I'm keeping it in mind. It is possible because that is what happens in a capitalist society. If the price of copper goes up drastically, then people who manufacture and engineers and scientists are going to look for substitution or look to re-engineer, as Tesla even stated that they're doing. They're re-engineering things so they use less resources in their product. That goes without saying. Okay, so my original view that I was holding was that, we're going to have this huge copper supply deficit. Okay, well, people like Robert Friedland are saying that. He's a copper guy that's a billionaire. He's interested in seeing the copper price go up. But now that I've seen this article and took in the information and thought about it, well, I have to incorporate that into my thinking. Will the gap be as big as we think? Will it be less? Is it realistic to think substitution and re-engineering can drastically reduce the amount of copper we might need? That has to go into your thinking. That's why we put articles up here, okay, to stimulate thinking. Okay, I know that was long and involved, but I just wanted to clarify that because we got a lot of new people here, and I just want to make sure that everybody understands what the purpose of these weekly videos is. So we had a couple reader questions that I wanted to, these aren't the exact quotes, but they're basically the gist of the questions. When I get questions that I think that are, a lot of times I just answer them. Don't email me questions, please, about specific companies. I'm not going to, very rarely will I, unless it's a subscriber that's asking for a clarification about something that I've talked about in the newsletter, that usually is on the Discord. We talk about those things, but occasionally, but I don't give recommendations. People, what do I think about this stock or stock? I'm not going to answer that because I don't know you. I don't know what you're trying to do financially, and I'm not a financial advisor. And it's not, something, if somebody asked me, well, yeah, I have a position in PBR. It's paying a 40% dividend yield. It's in my IRA. That's about all I'll say. Okay, I'm not going to give you the reason why. Get into, some of these things. So when somebody gives me a general questions like this, I like to bring them to the forefront for everyone's benefit, hopefully. So the first question, it was two questions by a guy that just subscribed. And so the first one was, when should I sell a stock? Well, this is an excellent question, actually, and I've talked about it before. I'm not going to be able to give you a one-size-fits-all answer about when you should sell a stock. I will tell you that it's very difficult, and many people fail at being able to do this, okay? And this is why their returns are not as as good as they could be. And this is not something that I've even mastered at this point in my life. Why? Because we are emotional and biased individuals. Okay. We have our biases. We have our things that we believe, things that, sometimes are difficult to change of why we think about things. Okay. And that influences our decisions. Our, what else goes into it? Risk tolerance. How much risk am I willing to take? What I would say is this, what I've said all along. Number one, before you start investing, you should have an investment plan that you have written out. What is the investment plan? You should talk about what you're trying to accomplish by investing. You should research and understand what are your expectations and are they realistic? The average return of stocks, if you held them continuously and reinvested dividends, I believe is somewhere in the research shows somewhere between 8 and 9% a year. Okay. Which is not bad. If that's not selling anything, buy and hold, reinvest dividends, or at least, with dividends included, the research shows all the ups and downs, it averages out to 8 or 9%, which is not bad. If you put that into a compounding calculator and said, well, I'm going to put $1,000, I'm going to put $300 a month into an S&P low fee fund in Vanguard and hold it from the time I'm 20 till I'm 70, you could gauge out what, you would have a pretty good substantial sum of money because compounding works. Okay. That's just, I'm not telling anybody to do that. I'm not saying the returns in the future will be the same. I'm not saying that. What I'm saying is that's the starting point of this. And so what people do when they want to become active, that's passively investing, which probably most people should do because they don't have the temperament, they don't have the time, they don't have the education. When I talk education, I'm not talking about going to some school and learning. I'm talking about self-education and reading and educating themselves on history and things like this, and psychology and all the things that go into investing. So people should probably just, read that one Meb Faber paper about just creating a world portfolio, which is possible to do, and you'll just get the gains. All the ups and downs will even out, and you'll get 8 or 9% a year compounded. And then you don't have to do it. You can go about your life. You can do what you want to do. You don't have to listen to these videos. You don't have to do research. You don't have to do anything. Okay, and you'll probably end up all right. But people want to be active because they see that it's possible that active type investors, there's many that we can point to that have been able to beat that average. Okay. But that is not normal. And so you get into a situation where I tell people to do this. Go look at the latest Berkshire Hathaway report. Okay. It's pretty generic. You open it up and the first page gives you the history of all the returns for Berkshire Hathaway throughout the years, going back to whatever it is, the 60s. Okay. And you will see, if you go all the way to the bottom, they will give you the compounded annual return through all the ups and downs. And it's about, I think the last time I looked, it was around 20%, give or take. Okay. So we have what's ostensibly agreed to or arguably agreed to as the best, if not one of the best investors of all time. Okay. Warren Buffett. And the fund basically, or the company he runs, it's an investment company, whatever, the partnership that eventually morphed into Berkshire Hathaway, the compounded annual return is 20% through all the ups and downs. So if you don't know anything and you're just starting out and being passive and just putting your money into a low fee Vanguard S&P fund or a world type fund where you set up several funds that mirror the world, okay, and rebalance, if that's going to get you about 9% a year through all the ups and downs, and then Warren Buffett, the greatest investor, is 20% throughout all his ups and downs, okay, why people have unrealistic expectations. They think, we've had companies in the portfolio that are up 100, 200, 300, 400, 500%. That's not normal, guys. Those are outliers. Okay. And when you shoot for that, you're taking on additional risk. And so you have to look at things These are the things you have to take into consideration if you're going to do this. You have to set your expectations correctly. Many people do not do that because they haven't looked at what is reasonable, what's possible, and what's reasonable, or what has been done. But that's just like saying, well, I'm going to play golf and think, or I'm going to play whatever sport, tennis, and I'm going to have the same results as, you know, a professional golfer that's at the top of his game. You're not. I'm not. You can get better over time. You can uh, learn over time, but you're dealing with real money now, okay? And so when I'm talking, I'm getting off track a little bit, but I want this kind of all ties together with even the second question. And so when to sell a stock? Well, you write down your investment plan. You write all this stuff down, what you're trying to achieve, retirement, college education for your kids, and that should help you determine what you should be doing, how much risk you should be taking, where you are in your life. You should go stand in front of a mirror and give a lot of thought to your risk assessment or to your internal risk tolerance. If you're somebody that buys a stock and it immediately drops 20 or 30%, which happens quite a bit, you think you've done all this research, you've got everything, you've touched all the bases, you buy the stock, and boom, in the short term, Mr. Market decides to knock the stock down 20, 30%, and then you become disillusioned, you become upset because this isn't doing what I want it to do or need it to do. Well, that's not what these companies exist to do, okay? And so what I advocate, after you have your investment plan, after you go through all this and understand if you're even emotionally ready and EQ wise and IQ wise to be an active investor, most people don't have enough capital. You really shouldn't be even being an individual investor. And this, I say these things, not to dissuade people. People are going to do what they're going to do. If you're got $1,000 in an Ameritrade account, you shouldn't be actively investing. Okay, what you should do is get yourself a grub stake. You need to get yourself 100 grand, 150, 200 grand together. And then you've got a chance to, breathe. You can build that up in cash, in a passive fund, whatever, what have you, okay? Or an ETF, and not take a lot of risk, because you can't really do what's necessary. So that's what I tell people. So if a stock so what you do when you buy a stock, you're buying a portion of a business. Okay, that's how you need to look at it. Most people don't look at it that way, and the financial system industry has set it up that way. Okay, with the technology, with smartphones, with the ubiquity and ease of trading stocks, they make it almost into a video game, like you're flipping baseball cards, okay? These are businesses that you're a part owner in when you become a shareholder of a business, okay? And so you should treat it that way. And so if you're buying part of a business, if your friend has a business that's growing and he asks you to become an investor, what would you do? Would you just give him the money because you'd go say, is this a viable business? I'd look at the books. Does the narrative and story make sense of my buddy and this management team's trying to do? Do they have a record of success? All the questions we've talked about before. And if they do, then and you feel like that is a better source of capital and the returns are higher than if you just invested passively, or currently you think that the forward returns on something like that are going to compound capital for you, because that's what you want to see, right? You want a company. I'm talking about investing now. And so when to sell the stock? Well, when you buy a stock, you should write down the reason you bought it. I'm buying this company A because I expect return on invested capital to be X. I expect earnings growth of X. It's going to enter these new markets. It has a new business that it started. I expect it to perform this way. And then you have to have some patience, and then you have to monitor it. I say this all the time, but most people don't do any of this. Okay. They just hear something on the internet, or they're from a buddy or whatever, wherever they get their information on social media, and they'll just open up their account and buy, I'm going to buy 1,000 shares of that. Sounds good. I mean, that's not investing. And so when what I'm saying is if the stock, some people will tell you, well, if you have 100% gain, sell half, and then these are all things that you can do. You have to incorporate it into your own thinking, okay? What I'm telling you is you should write down why you bought the stock. You should revisit it because it's a portfolio of businesses that you're invested in. And if the business is no longer performing, if the thesis you put together, say it's a turnaround and you're expecting something to happen as a catalyst, okay, that you thought had a reasonable chance of causing a revaluation in that particular business, and then it didn't happen, or the catalyst happened, but it didn't affect the stock, okay? Then you have to say, I'm selling. And sometimes you have to sell at a loss and move on because there's better uses of your capital. Conversely, I've told people, I've taken some flack on this. There's some things that are obvious pitches that you hit out of the park. When energy during the pandemic crashed, it was obvious to me, at least, that hydrocarbons weren't going away and they were mispriced. They were substantially priced lower than the cost of production, and that wasn't going to hold. I had a certain view on the virus and these other things. I thought was a little bit contrary to a lot of the mainstream. There was a lot of nervousness, and a lot of people thought things were going to be worse than they were. They weren't. Eventually, we came back, and as you can see, we've come back. Okay, so we bought certain shares of certain companies. I mean, I'll talk about one of the successes because it's illustrative for these purposes. I bought a company called Athabasca Oil. It's an oil sands producer in Canada. I don't particularly think it's one of the better operators. That's my own personal opinion, but it was so cheap, and it was a speculation. The speculation was under $50 a barrel. They weren't going to make it. Okay, they had too much debt. Their costs were very high. I don't particularly care for the management there, but it was so cheap, it was worth taking a position as a speculation because I did not believe that the oil price back then, few years ago, was going to stay where it was. I believed that it would increase and that it would go to a sufficient price that Athabasca would make it through, and that people were pricing it for bankruptcy, and that it likely wouldn't. Now, that didn't mean I went all in. I took a reasonable position size as a speculation, not as an investor, as a speculation that it wouldn't go bankrupt, that the oil price would go above 50, 60, whatever, as the pandemic receded and as things returned to normal and oil demand increased, things would be repriced. It actually went up about 8 or 10 times. I don't remember exactly where I sold it. It was something I talked about publicly. It wasn't even in the newsletter. And I sold it. Okay, it was up 8 or 10 times. If something's up 8 or 10 times on a speculation, you have to take some of the money down. So that's an example. And so what I hate to say is I can't give you every individual's different and every specific situation is different. But what I can tell you is that if you look at these things as businesses, as an investor in your investing, which speculation is different. Speculation is speculating on an increase in price, okay? Buying a business is where you want to buy a business, stock in a business, because you expect it to be able to have returns above what you could get for the risk-free treasury rate in long-term treasuries, because you trust and believe that the management, and they have shown they can, take the excess capital they get and reinvest in the business and allow it to compound over time. So that's what I would say. I mean, it was kind of a convoluted thing. That's where I would start, okay? Write down why you're buying these companies. Write down if it's an investment. Write down if it's a speculation. Understand what the difference between investing and speculating is, okay? And understand that each situation is going to be different. There's situations where you can get into a value trap, for example. Everything that you thought was going to happen with the company happened, but the market never recognizes it. For example, there are many oil fields, very small, well-managed, in my opinion, companies that trade on the Singapore exchange that are oil field services companies. They are really lagging the what you see of the mainstream ones on the NYSE that we follow. Okay. Why? Because the ones on the NYSE have liquidity. Everybody sees them. They have analysts tracking them. I mean, how many people even can name one stock that trades on the Singapore Exchange? But there's a ton of companies there that it looks like are finally starting to get some traction. Nobody cares about them. Their businesses have already turned up, but they haven't responded like the ones in the US because there's no sponsorship. You got to have some push behind it. Some liquidity's got to come in and push the things higher. Or you can buy a company. That's, could be a value trap where you got everything right and the market just never revalues it higher. That can happen. Okay. So every instance, every situation is different and every person's different. So there's a lot of work that has to go in before you even start committing capital. And then once you commit capital, all I can tell you is, to thine own self be true. People ask me sometimes, well, they'll say this company's down, some random company. I mean, and I tell them the same thing. If you're laying in bed and it's midnight and you can't sleep because you're staring at the ceiling and your stomach's turning and you're worried about a stock that dropped 30%, you should sell it. You should not put yourself in that kind of physical discomfort over a stock. Just sell it and take the loss and move on. Because I can tell you that in this game, if you can be wrong more than 50% of the time and still become tremendously wealthy. Because if you let things play out, the winners play out, they will more than compensate you for the bad decisions. And you're going to make a lot of bad decisions. You're going to make a lot of bad calls. That's just, even professional people do that. Okay. So that's what I would say. It's kind of a long, convoluted answer. I get it, but that's what I would say. The second question is, I'm a young investor starting out. What is your advice for someone just starting out investing? Understand compounding and understand time. If you're young, you have a lot of time. That's your greatest resource. Okay. You need to really read about and understand how compounding works and why it takes time to become wealthy. But the problem is with a lot of young people that want to get into investing, they look at it as a way of being free money. You saw that during the cryptocurrency craze. You see that even in certain sectors get hot and they get on a winning streak. I've said this before, and I don't say it to be mean. You're walking down the street and you find a diamond ring in the gutter. You find $1,000 bill. They don't have $1,000 bills, but they used to. Say you find a $100 bill laying in the gutter and you pick it up. That doesn't mean you're a good investor. You're in the right place at the right time. Are you able to have consistent returns over long periods of time through different market cycles? That's what determines whether or not you're a good investor. Because if you're in the middle of a situation where the market is up over a 6-month period or a year period, 30%, that doesn't make you a good investor. You're in the right. Hey, Allah be with you. I'm happy for you that you made money, but don't confuse that with intelligence and skill. I did that a lot when I was younger. Okay. There is a certain amount of luck involved. So that's why you use pattern recognition and probabilities when you're making assessments of where to deploy capital. And then sometimes you get a lot luckier than, you put yourself in a situation to become lucky where you get a takeout bid and you get the big, payoff, or the thing exceeds your expectations or what have you. Okay. Or something happens very positive that you didn't anticipate, but you put yourself in that situation for that to happen. So this is why I really encourage people to read a lot about poker, the mentality of playing poker, because this is a lot. People think poker's gambling. It has a certain amount of luck component to it, but there's a lot of skill involved in probabilities and pattern recognition. This is why I tell people I'm not encouraging to go become a poker player, but reading books of the theories behind it, it really gave me a lot of insight into how to think about these things. Okay. And so time, don't be in a rush. Everybody's always in a rush. Remember the one thing that Buffett said, this is a game. This is like a baseball game where no balls and strikes are ever called. You get to stand at the plate continuously and there's no balls and strikes called. So you can stand there until you get a pitch that you can really hit. You don't have to swing out of the strike zone. You can wait for that fastball right in your wheelhouse and then you can swing on it. And so You can accumulate cash. You can increase your cash coming in. You can save, and then you can deploy the cash when you see the right situation come along, because there's always going to be more opportunities coming. That's the one thing I have learned. There will always be another opportunity. If you miss one or if you get something wrong, there's no reason to get upset. It's just like if you make a bad putt in golf, you got to put that behind you and move on to the next hole. That's it. Starts all over again. And so this is a lot of psychology involved. So time, I think, is, don't let that time work for you. And if you're trying to get rich in a year or 6 months, or, I get this constantly, give me a stock that's going to go up 100% in the next couple months. I mean, nobody can do that. No one can tell what's going to happen. It's very unrealistic. And so what you want to do is, like I said, if you can just get above, as an active investor, above what the average is, which is 8 or 9% a year, and I think that that's possible to do, then you will compound your capital consistently over time and you will become a wealthy person. Okay. If you're always shooting for the quick buck, if you're trying, buying stories all the time and chasing shiny objects, that's just you're going to get lucky occasionally and make money, but it's not going to be consistent. Okay. And then you're going to start wondering, why am I not making any forward progress? I'm kind of stuck in the same spot. One year I'm up, one year I'm down a lot. There's no consistency here. Why do I have some of these companies in my portfolio that are down 30 or 40 or 50%? I don't even remember why I bought them. This is what starts to happen. So that's what I would say. I don't know if this is helpful, but this is my advice. So I wanted to point this out. Credit card debt topped $1 trillion now for the first time in the U.S. I like this chart that this guy put up, Charlie Bilio. He's talking about the growth. This is the year-over-year change in credit card balances. This is coming basically after the pandemic. You saw what happened. And what I find, it's kind of looks like it's gotten pretty high here, topped out. But, total debt is, like I said, credit card debt's $1 trillion. And the other thing I pointed out in another video maybe a month or two ago, was that the banks have raised rates to the highest levels ever for credit card debt. So if you have outstanding credit card debt and balances, you're paying some of the highest interest rates ever on that debt. That's another thing that you should not do. You should not be in debt. Pay your debt off. But this is part of the ongoing information things that I have to process. Some things, I'm thinking to myself, okay, this is not positive, because especially in the context of a economy that's 70% consumer spending, which is the U.S. economy. I mean, how in debt can people go? How can they service this debt? As long as employment is positive, which it is, a lot of people have gotten that wrong, especially myself. I thought, we would already be seeing increases in unemployment, but evidently we're not. So people can make the minimum monthly payments as long as they have a job. I guess that's really how a lot of people think. So I wanted to show this. This is federal debt. So I've talked about this many times. I think this is, I don't think it's amusing. I just think it's crazy to look at this. This is basically the bottom, not a bottom, but the coming off the most recent bottom of when the Fed started raising rates. And as that debt rolls off and they have to refinance, because we don't pay our debt back, it rolls off, then you have to refinance more, and then they do more spending. We go further into debt. I mean, interest on the debt increases. So you have defense spending here, which this is alarming also. We're raising this up during a time when we have record deficits and record interest on the debt. We're raising defense spending every year for whatever reason. Well, we know why. I'm not going to get into that now. But, again, wait for the headline that is coming, where interest on the federal debt goes through $1 trillion. And that will be like some headline news that people will process. But this is not a sustainable trend. If I showed you this was a stock chart, this blue line, would you buy this, or would you be hesitant to buy it, or maybe even think about shorting it? I mean, it's not sustainable. So one of two things is going to happen. More than likely, I don't think rates are going to stay where they're at for much longer, just because at some point this is going to become a problem. compound interest works for the saver, but works against the debtor. This is what ends up undermining a lot of empires. So this is housing affordability. So this is the median sales price of houses sold divided by real median household income. And you see, like back in the 80s when I was just coming up, you know, houses were reasonably priced with respect to people's incomes. And now we have a situation where, I believe because the financialization of this economy, of the US economy over the last 30 or 40 years, which is a long story. But anyways, long story short, you now have median sales prices over 550% of people's income. So, if the values of the homes go up, which I believe a lot of this was affected by zero interest rate, very low interest rate policies, right? That allowed people to take on more debt and buy bigger houses than they would normally have been able to do if interest rates weren't artificially suppressed, which they were. Wages have not increased the same. Okay, so incomes have not went up at the same rate. And so how many people can actually afford a home? That's the complaint you hear from a lot of millennials, people starting families. Rates are too high, price of housing is too high, affordability of housing is a major problem. And a lot of it has to do with the financialization of our economy. And so I don't look at this as a positive. You're limiting the amount of people. And so what you will see is you see policies being enacted for first-time home buyer policy. The government's going to create some program to help you get into a house. You only have to put 3% down on a Fannie Mae mortgage, something like this, whatever it is. And whatever they can do, because as I've talked about with cars or automobiles, the same way with housing, people don't look at the actual cost anymore. They just look at what's the monthly payment. Okay. And so because the economy's financialized and people are incentivized to get you a mortgage and get you in a house, okay, well, they'll do what they need to do. We've seen this before, and this isn't positive for society or for the economy long term. I just wanted to put this up. This was I saw this tweet. This is the salaries of your Federal Reserve officials, all of the pointy shoes over there, the masters of the universe. You can see here, this is the presidents of the various banks, Fed banks, regional banks. You see their salaries. They're all around 400, 500,000 a year. It's a pretty good gig, right? Then you have, I'm sure they get all kinds of other benefits in addition to that. Then just, what I guess I'm saying is I just find it amusing because, have these people ever been right about anything? They've come out recently, I think Mr. Powell or some other Fed officials, they don't see a recession now in the future. Well, that's good. I mean, I guess what I should do is get out like a pad and write down and put it on a slide, like all the things that they've said in the past that turned out. Remember when they said that inflation was transitory? They say a lot of things. I don't really put a lot of stock into a lot of things they say because a lot of their forecasts are not correct. So I don't know. I just thought this was amusing. I thought it was interesting to see what they're pulling down. Then it shows, all the employees that work at these banks, which are, except for a few, they're well over 1,000. Some of them have over 2,000 employees, like in the New York Fed. I thought it was kind of curious that the Kansas City Fed has 2,000 people working there. Maybe that's because of all the agricultural data they have to process. I don't know. I just thought it was, I found this interesting and wanted to bring it to your attention. You don't really see this too much. So I wanted to point this out, China did recover, but it didn't recover to the extent I think that a lot of people thought, including myself. And so I saw this, domestic air travel in China is above the pre-COVID level, but you see international travel, which is the real distillate guzzler, is still 50% below pre-COVID. Now, I did see that in China, they just changed some policies around tour groups going on international travel. They had a lot of policies restricting international travel. So I think that's going to open up and slowly get better over time. This isn't going to be the sole driver, obviously, of the oil price, but I just thought it's interesting, that the demand didn't come back fully, and that this should be another component of demand that's slowly but surely increasing. We've seen it time after time over the last few months where we've seen demand for various oil products, whether it's gasoline, diesel, what have you, exceeding now the pre-pandemic levels, especially in a lot of the emerging markets. And so we'll see what happens in China. But I mean, these are the vignettes. These are the little anecdotal things that we keep an eye on to try to give us some signal of what we can anticipate in the future. So this is a Tavi Costa chart from Crescat Capital. They have a lot of good videos on their YouTube channel. I enjoy watching them. I don't necessarily agree with everything they say. They're big on gold, investing in gold juniors, but they do a lot of this type of things that I think are thought-provoking. So in yellow, you have the XLE ETF share price, which is the oil stock, basically energy stocks ETF. And then you have the WTI oil price. Now, it only goes back to 2020, but you see that in the recent past, the XLE and the oil price have kind of traveled together fairly closely. And then they kind of decoupled in 2022, and you see that the oil price is down here, although it's recovering now. We're having a rally. But you see that the energy stocks really hung in there. And so you have to say, well, if stocks are a discounting mechanism, what were they discounting? Were they saying that this drop in price was actually temporary? Well, it looks like we're having a rally now. I think we're up 6 out of the last 7 weeks, something like that. Maybe it's 7 out of 7. I don't know. So again, my view is that I have a long-term bullish stance on oil. Long-term over this decade, I believe that at some point in this decade, we're going to make a new all-time inflation-adjusted high in the oil price. But I have no idea what's going to happen with the oil price the next month, 6 months, or probably even a year. And so I do think, though, that there were some areas that you could have targeted that you still have opportunities in, right? Do I think, like I talked about Athabasca, just using it as an example, do I think 10 baggers still exist in certain E&Ps? I'm sure in some of the juniors they do. I'm not familiar with a lot. I don't play down in there. There's a lot of people that do. And you should follow them, and they can give you a good, they can, clue you in on some of those opportunities. There's a lot of junior companies in Canada and some other places that are always doing work. And if you do the work, you can sift through a lot of information, find out some companies that have that potential. But I think there's more potential, like I said, like I've been saying, in a lot of the offshore service stocks. Now, they've moved quite a bit too since I originally started highlighting them. And so I don't think there's a lot of 10 baggers out there, okay? Like there was, when something happens drastic, like it did in the pandemic, and the thing just collapses like that, that's where the 10 baggers, that's the setup for the 10 baggers. Do I think that the oil price will go higher? If it goes higher, that a lot of these companies' cash flows will increase, and yes, okay? And some of them will probably do well, exceptionally well, where you'll have triple-digit returns, but it's more difficult to find those type of layups, okay? Now you're taking harder shots. That's the point I'm trying to make when I'm talking about these energy stocks, okay? Yes, I think at some point that we're going to have a crisis because of the underinvestment. I don't know when it's going to happen or if it will for sure happen. But I think that, now that we're finally seeing the data come in where a lot of the international oil companies and certainly a lot of the state-owned companies are, increasing FIDs, putting that big money into those offshore developments, and just seeing and listening to the last few quarters of reports from a lot of the service companies offshore, I really think has a higher chance. And you actually spread your risk out better, right? Because you're not tied to one individual company, the management of that company. I'm talking about, if you buy an individual oil company, I'm not saying, I own individual oil companies, don't get me wrong. But I'm saying that if you're in a service sector, they have multiple customers, and that kind of, I just think you have more opportunity in that in those sectors, and that's offshore. I actually have some onshore companies in my portfolio, and as I've said, they really haven't performed, and they have recently woken up recently because of this increase in oil price. But I'm seriously thinking about shifting everything to offshore just because I believe that the returns are going to be higher there. I think that it's becoming obvious that we're getting to the end of the shale revolution. That doesn't mean that it's going to end, but the opportunity for the onshore service companies to really, have multi-bagger, I don't see the same opportunity onshore as I see offshore. So it'll be interesting to see if these recouple or if energy stocks come down or the oil price goes up, or it's a combination of both of them. We'll see. I just got this chart off Twitter from this Anhas, what's his name? I forget his name, the guy that's always talking about he's a pretty popular commentator, but what it was talking about different predictions of peak oil demand, which I never really bought into because I just don't see for what oil and hydrocarbons are used for in the world in a modern society. I don't see viable alternatives that scale. Yes, you can tell me about the plant in Sweden that doesn't use met coal in making steel, but is it scalable to the tens of millions of tons of steel that get made around the world? And is somebody going to, what's the cost relative to just using coking coal in a Bessemer process in a blast furnace? Well, people in China and India and these places are going to go with the cheapest option. And so, yes, you can always tell me about the one company over here that's been subsidized to create a process to create whatever. And that's why, we don't need oil anymore or whatever. I don't see the stuff scaling. And so I think eventually, because the price of oil will increase I don't think we ever run out of oil. I know it's hard for people to conceive. What will happen is, the easy to find stuff and cheaper stuff gets found and used, and then you are forced to exploit more costly and more difficult resources, and that forces the price up over time, the floor price, and then that's when innovation and substitution starts taking place. Okay. And that's what you hope for, at least, right? And because oil is so inculcated in everything that we do, especially in these emerging markets, people are just forgetting about how many people we're talking about and what's happening. And these people are not going to have an energy transition when they're in the middle of their industrialization and modernization. It's just not going to happen. They're going to use whatever is the cheapest, most ubiquitous, easy to obtain energy source. And so we just go through here. It says BP's evolving views on peak oil demand. Back in 2017, oil demand may not begin to fall until the second half of the century. Okay. Well, as ESG came in, became popular, and that zeitgeist took over, views started to evolve. This is what corporate entities feel they need to do because they don't want to be, in the media spotlight or be portrayed as, some guy walking around in a, black overcoat with a black top hat with a pencil thin mustache as the evil, oil guy rubbing his hands together. So in 2018, they said, well, oil demand could continue to grow until around 2035. And then in 2019, they said plateauing around 108 million barrels a day in 2030. And then in 2020, they said that oil demand has peaked in 2019. This is when was another thing that we use as a contrary indicator, when we had major oil companies even saying that we had peak oil demand, not supply, demand. If you remember, that was one of the things that I talked about, why it was such a buying opportunity, because you had so many people coming out in the media and politicians point, this is our opportunity. See, if we lock everybody down, you saw how much demand dropped. Yeah, demand dropped from about 100 million barrels a day to 88 million. That's what shocked me. That's what made me realize oil wasn't going away and that it was a temporary phenomenon. It was a tremendous opportunity. And so now here we are in 2023 and oil demand's at 102 million barrels a day. And I don't see any reason why it won't continue doing what it's done in the past on the demand side, which is grow between 1 to 1.5% a year in demand. That's what we've kind of seen, over time. And I think that will continue. until the price gets sufficient or the supply becomes constrained. Now, I'm curious to see what happens when the major growth engine for oil supply in the world, which has been U.S. shale, now is showing signs of plateauing. We know that the Eagle Ford and Bakken have plateaued. What happens when the Permian plateaus? What will be the growth engine? What happens when these things plateau and go into decline? All oil fields go into decline. All wells and fields eventually go into decline. It's irreversible at some point. Yes, you can stimulate the well. Yes, you can do CO2 stimulations, chemical treatments, acid treatments. You can do water floods. These are all enhanced recovering techniques, but it doesn't give you more oil. It gives you more higher recovery rate of the oil in place, and it becomes progressively more expensive and more difficult. That's why I'm bullish long-term on oil. Again, secular bull with the occasional cyclical downturn. So I want to get into this. A lot of people want to know why. One of the reasons I believe that I think this is hilarious. Again, I think you should familiarize yourself because there's going to be billions of dollars put into this. It kind of reminds me, if you remember that movie Aliens, when they went to that planet to rescue the colonists with Sigourney Weaver, and they were flying there, and they said, well, they're reforming the atmosphere. They had these huge nuclear-powered atmosphere generators or something is what they called them. This is what this kind of reminds me of. But that was a science fiction movie. But evidently, that's what we're going to do in the U.S. for CO2, because CO2 at 0.04% of the atmosphere is so dangerous and such an existential threat. As a matter of fact, Western politicians have told us that it's the most existential threat to us that we face. Okay. And so what they've determined is that carbon capture on fossil fuel plants is not going to be sufficient. We have to do direct air capture. And this is actually being moved forward. So here we go. Oxy and Climeworks, big winners I put in DC CO2 handouts. And so what's going to happen here is this is direct air capture. And I'm going to introduce you to a guy that you should read his article because he'll explain it to you and he'll explain why it's a boondoggle. But basically, they're going to create these huge plants. And what they do is they pull air in from the atmosphere and they remove the CO2 and concentrate it. Now, just process what I just said. You're going to pull in this trace gas along with, you pull in a cubic yard or whatever of air, and the constituents of that ostensibly would be, mostly nitrogen, oxygen, 20%, whatever. And then you have your trace gases in there, one of which is CO2. Okay. And they're going to expend energy to take a diluted gas of 0.04% composition and concentrate it. So right off the bat, if you have any kind of physics or chemistry or engineering background, you should already understand that your second law of thermodynamics should be flashing in your head right now. You're trying to reverse entropy, which you can do. This is what I said of the basis of civilization and why we need energy inputs. Basically, that's what we do. We use machines in our lives to reverse entropy. Okay. And it requires energy inputs for the machines to work to allow us to reverse entropy. When you mow your lawn and weed whack, you're reversing entropy. If you let your backyard go, it will get more and more chaotic back there and require energy inputs to bring it back into order. I mean, this is about as simple as I can get. So anyways, Oxy, which is a big oil company, gets most of their revenue from this, is now in the trough, in the DC, climate trough handout. So it says, this is an article. I'll put the link in the show notes. The U.S. Department of Energy is investing $1.2 billion in giant vacuums that suck carbon out of the air, an effort to slow global warming. The whole thing sounds nonsensical in the first sentence. And if you know how thermodynamics works, I mean, anything can be done, but how much does it cost and what's the benefit? It says the initial funding will create 2 carbon removal hubs in Louisiana and Texas, run by startups Climeworks and oil company Occidental, respectively. The money from the bipartisan infrastructure law will now help fund 2 direct air, or DAC, they call them, hub projects, direct air capture, one in Texas and one in Louisiana. They will eventually remove more carbon per year than all of the current projects combined. Once the carbon is trapped, it can be stored underground or used for various other resources, from building materials to agricultural products, even to man-made diamonds. Isn't that wonderful? Again, I'm not an expert on this. Okay, what I do know is that I know how thermodynamics and entropy works, and I mean, it's not impossible to do this. This is how air gas and Praxair make, you know, when you see them delivering nitrogen somewhere or oxygen, that's what they've done. They have plants that do this. They have energy inputs into their plant that pull in this and extract these gases. But the value of the gases to their customers allows them to, the needs and the uses for those gases exceed the cost of doing what they're doing, which is taking gases in a disparate form and concentrating them, reversing entropy. Okay. Do you understand what entropy is? It's when like hot goes to cold. It's like, if you have a compressed gas, it's going to become more, I don't want to get crude here, but you should figure this out. Things go from, order to disorder, energy dissipation. That's what I'm talking about. So you're trying to reverse that, which can be done, but you need tremendous energy inputs. And so we go back to the idea of is this really going to do anything if we live on a ball? If we had a covering over the continental United States and we had no other atmospheric inputs from the rest of the world, maybe you could make a case for this, I guess. But this to me is just what it always is. It's a sop to politically connected people to solve a non-problem. We had the same thing. I remember, maybe a lot of people don't remember, but in the 70s we had an energy crisis after the Arab oil embargo and things like that. And one of the things that happened is you had a lot of the major oil companies, during the Carter administration, they were going to develop all of this shale rock in, I think, Wyoming into oil. And they spent billions of dollars trying to take this rock. I don't know the whole process, and they were going to process it, and they could do it. They demonstrated a process, but the problem is the end resultant oil product was too expensive. Okay, they couldn't get it to work at a cost that was viable for the long-term prospects of the business. And so the government just can't continue to put billions and billions of dollars into something that, it's just not going to work. Administrations change, priorities change, the oil price crashes. I remember in the early 90s, maybe it was the mid 90s, oil was at like $10 or $12 a barrel. Okay. And if you're producing oil out of the shale rock at $80 or $100 a barrel, it's not going to continue. It's not going to continue if it's all based on subsidies. And so again, I think, this is, Warren Buffett loves this stuff. That's why he bought Mid-American Energy, the utility. They're very big in renewables. I just remind you of what he himself said at one of the, I don't remember what year it was, but somebody asked him about Mid-American Energy and its push into renewables. And he said, well, there's tremendous tax benefits and subsidies that are given. If we didn't have the tax benefits and subsidies from the government, we wouldn't do it. And so this is kind of the same thing, okay? And this allows Oxy to continue to say, well, produce oil and gases, which is their core competency and their main business. But then they can point at this and say, well, we're the forefront of this. We understand how our product affects the atmosphere. And look what we're doing. We have the largest direct air capture plant in the world, and we're removing, what did they say here? It can remove more carbon than all of the other carbon removal plants in the world. And aren't we wonderful? And that gives us a pass. See, I don't believe in any of these concepts of that using fossil fuels is some type of sin in this new secular religion that they've created, and that I need to pay indulgences and carbon taxes to sustain my life. Okay. And so again, you have various constituencies. It's not a conspiracy. It's just the way that the system has, devolved into this basically sops to politically connected people, and they're going to give free money away. So why not take the free money? That's how it works. Okay. And not only that, it gives you your green energy props, and then you can use that in your advertising and in your messaging to people when they point out, that you're basically an oil company. But we understand that we're sinning, but here's what we're doing. We've bought indulgences. So again, I'm not an expert on DAC. Maybe it'll work. I point out this, hold on, let me get past this. Maybe I didn't put it on here. Oh, here it is. I should have put this right after. So I skipped ahead a little bit, but this is an article that was written in October 2022. It's on LinkedIn. It was written by this gentleman, Paul Martin. He says he's a chemical process development expert, antidote to marketing hopium, tireless advocate for a fossil fuel-free future. So he states right here that he's an advocate and if you read what he says, he believes in, that CO2 is an existential threat to humanity and that we need to get rid of fossil fuels. So let's establish that. But he wrote an article a year ago and basically said why direct air capture sucks and not in a good way. So he goes through, and I put up here, because this was also in his article, he said the idiot cousin of carbon capture and storage. He's talking about DAC. So if you really want to understand why it's not going to work, it's not going to do anything, it's a waste of money, and it's just another sop to connected companies and individuals, I encourage you to read this. He actually also puts, there's a couple of videos that he linked to in there on YouTube for some people that were goofing on this whole thing, DAC and carbon capture, from some other environmental people. So this guy's understands chemistry and chemical process. And so I thought it was instructive that this guy, thought that he wrote this article. He explains the process. He explains the expense and why it really won't do anything. And I suspect that, they being the powers that be, they'll tout all this, because the Biden administration has really gone all in on the existential crisis of our time. I saw the push you're seeing now in the media is trying to create a narrative around getting the president to issue, the administration, I should say, issue an executive order stating that we're in an existential crisis. So that will, in people's minds that are for this, say, well, that will give the government more power to do what they want, okay, which is to restrict this, use of fossil fuels, something that won't fly, okay? And so that's what they're angling for. It's 2 steps forward, 1 step back. And we already know what happens in other countries and states in the U.S. when we take away energy sources that are cheap and ubiquitous. The price of energy goes up, and it causes knock-on effects in the economy. All right, so again, this is just to remind you that just another forecast, again, taking into context the what we talked about last week about recycling and substitution and reengineering, but copper needs 250 billion in investment by 2030. So you have actual capex last year. This is the projected cap. This is the committed capex, and you can see we're nowhere near what we need to bring on the sufficient copper. I just bring this to your attention because one of the portfolio companies we have is a company that helps mining companies find and establish their resource bases. So the thinking is that will benefit from all of this increased investment. So we just talked about direct air capture of CO2, and yet we have China approving 50 gigawatts of new coal power. You can't make it up, folks. You can't make it up. It doesn't matter what the U.S. does. It doesn't matter what the state of California does. It doesn't matter that New York State, is at least in reference to CO2 emissions, what they make you get rid of your gas heater, water heater, and gas range and stop making wood-fired pizzas in New York City, it doesn't matter. It only matters what China and India are doing. They are the primary drivers of CO2 emissions in the world. Okay, nothing that you do anywhere in the US or Europe is going to have any effect on any of this, if that's what you believe. And so the question I ask is, what are we going to do? Are we going to go to war with them? Are we going to sanction them? Are we going to have economic warfare? Are we going to confiscate their assets because they won't stop building coal plants? What are we going to do? Because emissions are going to continue to go up, folks. I think it's a good thing personally because CO2 is used in photosynthesis. But I'm not going to get into that again. But what are you going to do if you're? This is what I tell people. You can advocate for things and you can have the opinion you want, but you need to tell me how you're going to fix this, because they're not stopping. They're going to do what they think is in their best interest. And so let's look at the article. Last year, China emerged as the world's clean energy champ, with the country accounting for 546 billion, or nearly half of the 1.1 trillion that flowed into the sector as countries everywhere rushed to beef up their energy security. So China last year spent 50% of the money that was spent on clean energy in the world. Interesting. The article goes on to say China's government has put energy security and energy transition at odds with one another. Beijing has clearly stated that coal power will still grow at a reasonable pace into 2030, Greenpeace's Gao Yui has told Reuters. China's coal output increased 9% to 4.5 billion tons last year, more than half the world's total, and is set to continue to rise in the current year as Beijing looks to offset a 22.9% decline in hydropower generation. And so, yes, we are at odds. In the West, we have put the energy transition and CO2 as which we've declared as the public enemy number one, as our primary directive. We haven't put energy security as our primary directive. Okay, we're trying to restrict the use of energy in the West, okay, for this unattainable goal, because we have governments around the world that prioritize energy security and development, and they're at odds. And so if you're an advocate for this, for shutting off making pizzas in New York City with wood, and you think that that's a good thing, then you need to explain to me and everybody else what you're going to do about China. What are you going to do about India? What are you going to do about Japan and South Korea that built new coal plants? What are you going to do about this? They have a website that shows you, I have to find it again. I don't remember what it is, but it will show you every coal plant under construction or being planned. Coal's not going away. And so the CO2 emissions are going to keep coming. Oil use is not going to go away in these countries. And so the CO2 is going to keep increasing. And so, committing economic seppuku in the West is not going to have an effect. You're going to become poorer and less relevant in the world. Your populations are going to have harder lives. And yet nothing's going to change with respect to CO2 emissions overall. And no one can explain that. It's just ignored, because that's not really what it's about, in my view. So one of the things that you will hear is that nuclear takes too long. It takes too long. Well, it takes too long for a reason, at least in the West, is because we've overregulated everything and we've made everything very difficult here. Okay. They haven't done that in the rest of the world. That doesn't mean you have no regulation. It means that you streamline the regulation. It means that you do things like choose one or two reactor designs that everybody builds to, the same design. Things like this, that you speed up the regulatory process, that you look at optimizing engineering and construction techniques, that you don't build plants as one-off, so they don't take as long. You turn it into a manufacturing process instead of a one-off design, which is what we did in the 70s here in the U.S. We built a lot of plants, but a lot of them, they weren't standardized designs. So you have all these different types of plants, even on the same location. Sometimes you'll have sister reactors. They're not exactly the same. It makes no sense. And so that's the argument that's made quite a bit. But I wanted to point this out. This chart I thought was interesting. It talks about, here's the amount of renewable energy in Denmark and Portugal, wind and solar. But did you see here, this is the UAE, and it's bringing on its 3 reactors, first reactors they brought on. You saw, once you put the bit in your mouth and go and decide to do something, you see how fast they're so large and so powerful, these reactors. You saw that what was accomplished by Portugal and Denmark in 20 years was exceeded by the UAE in about 5 years. And they're going to bring another reactor on. And so that's another canard that seems to be out there for, and here's if you see up here, this gray, you kind of may have missed it. This is a UAE nuclear target way up here, and they'll be there before 2025. And where's Portugal and Denmark going to be? And what's the cost relative? Now, people just keep throwing these canards out about this is one of them, or people are misinformed on this. And that's why I talk about these things. If 1 or 2 people, at least in their mind, consider this, and then they tell 2 or 3 people, you start changing minds one at a time. The waste issue is another canard. I'm not even going to get into that. So I wanted to point this out. We've talked about this, I think about 6 months ago. Ford was going to lose, I think at the time, around $2 billion on the EV projects they were doing. Now it looks like Ford will lose $4.5 billion in EVs this year. Ford is slated to lose $4.5 billion from its EV segment this year, a $1.5 billion larger loss than the company had expected. So far this year, the division has lost $1.8 billion, and this year's $4.5 billion loss figure blows away last year's $2.1 billion loss. Ford also announced that its electric F-150 pickups will undergo a price cut. Ford now says it's, quote, throttling back on plans to ramp up EV production. It blamed the price war for EVs as part of the cause and told shareholders it would need another year to meet its target of 600,000 EVs produced annually. And so here you are, folks. I mean, at some point you have to make money or it's going to be a problem. So they're throttling back now. And so they were blaming the fact that Tesla cut prices. I'm just telling you that this doesn't work. Okay. Wealthy people drive these things. The average person, I just pointed out, can't even afford a home. They can't afford $60,000 Teslas or whatever. Okay. The average car payment for people now, or not the average one, but 25% of the people in the country have a $1,000 a month car payment. Who's going to buy these things? Okay. This is the problem. Yet, Build Your Dreams, a Chinese company, is now invading the European EV market because they can produce a vehicle. I should have probably looked it up, but I heard this on another podcast for like $11,000 or $12,000 an electric vehicle. That's what you have to do. You have to produce something like that, and then it will become viable for the average person. Who's buying an F-150 Lightning? I think the thing costs $80,000 or $90,000, and it's, it doesn't. People are turning them back in because they're not meeting their expectations. So we talked about this already. I'll put a link to this. I thought this was interesting. Could Nord Stream pipeline return to service? Well, this is from the CFO of E.ON, and also there was a conversation with the head of, this was like some kind of talk in Germany. I didn't really get the article. It was just in a tweet. But it says here, quote, options are now being explored to drain and protect the pipeline, unquote. This is supposedly a quote from the CFO of E.ON, which is one of the largest utilities in Germany. They also have assets around the world. Then it goes on to say the head of the Union of Employers of the Metallurgical and Electrical Industry of Germany bluntly stated that the absence of the Nord Stream led to an outflow of investment and business from the EU. Quote, Germany, this is him saying this. This isn't John, because everybody comes at me. Again, I'm just reporting the news. So the head of the Union of Employers of Metallurgical and Electrical Industry said this, quote, Germany is no longer competitive, mainly due to poor general conditions. No country has higher energy prices, unquote. And so I'm not going to go out on a limb and say that I'm ready to say that Nord Stream is going to eventually be put back online. I think one of the pipelines is still undamaged. But when you have the CFO calling for it to be put into layup and some action to be taken, that tells you that he's thinking that he wants to see it come back online at some point. Now it'll never be the same volumes because you'd have to rebuild what was blown up, but we'll see. Again, we'll see what happens this winter. We'll see if the deindustrialization of the EU continues because of high energy costs. We'll see what happens over time, and we'll see if mindsets change. Again, the political zeitgeist is changing in Europe. It takes time. Go through election cycles for people to feel the pain, to start attaching, changing their thinking. Again, I've told you this before. There's a good 30-40% of the people in the world, they're never going to change their view one way or another, okay, on either side. And so you have maybe 10 to 20% of the people that determine that are open to having their minds changed and can influence this. That's why you're seeing polling in Germany turning against the advocates for the energy transition and for all these policies that are not in Germany first type advocacy. So I'll point this out. This is another guy I follow. He's a pretty good guy. I would follow him on Twitter, Chris in Canada. He had a tweet that says 44 new 52-week lows on the TSX today, and 30% of them were green energy linked stocks. Gives a rethink to what was being dubbed the old economy and the said green energy transition. Yeah, they don't make money. There was a company on there I saw was Northern Power, I think. This is a company that I owned like 10 years ago when it was building a lot of plants. They were mostly in Canada. And then they kind of moved to some big projects, I believe, offshore in Europe, like in Denmark, and they had a bunch of problems with them. I sold the stock many years ago. They were on this kind of growth trajectory, building wind farms, and they had some other plants, natural gas plants too. They had a mix of assets, but they had this big thing of wanting to build these huge plants offshore, and I think they ran into some trouble. I sold the stock at a long time ago, but I was shocked to see how low it had dropped. When I went and looked at the chart, it was selling. I mean, I sold it like in the 40s, 30s or 40s many years ago, and it's down to like $9. And so it's not working. You have to make money at some point. So, and I just wanted to point this out in closing. No commentary. I just wanted to point it out. Profits of Western arms makers top 200 billion. US, EU, and UK defense contractors have been major beneficiaries of weapons sales to Ukraine. Well, that's a major constituency in DC. Again, it's not a conspiracy. It's the way the system has been allowed to devolve. Politics in DC, and probably in most states at the legislature level and government, these people are not concerned about regular common people. These are their this is one of the constituencies, is the military-industrial complex. And I've explained it before. Somebody called it, I think Douglas McGregor or Scott Ritter, somebody called it the military-industrial congressional complex, because when, say, these defense contractors get a contract, a certain amount of that money is used, that they get goes right back into campaign contributions. And so again, it's nothing nefarious. It's people responding to incentives. If you take the money out of politics, maybe some of this would go away, but you can't be in politics without money. Mr. DeSantis is finding that out now. Okay. He started espousing certain views that maybe he thought he had, and then big donors told him that they don't want that. And so, this is why he looks kind of wishy-washy and limp. So anyway, this is the same thing in pharma, same thing in medical insurance, any kind of big thing where tens or hundreds of billions of dollars are involved. There's going to be a constituency that grows. Renewable energy, there's a huge constituency around it now with a lot of lobbying that goes on. So that's why it won't go away. And that's why you're going to see the debt continue to increase. The Congressional Budget Office says that sometime like 2032 or 33, the federal deficit will be $50 trillion. I think it'll be 50 trillion before then, before the end of this decade. I don't see any reason, the trajectory on, again, there's no constituency, there's no arm of the and Congress, maybe a few couple, crackpots here and there that are for cutting spending. They don't care about regular people. Okay, they respond to who gives them money. If you drop money in the sock, you get access, and you have to do it consistently. And it's not just limited to $2,500 campaign. You have to set up a PAC and millions of dollars. You got to come with millions of dollars, and they will listen to you then. They will listen to you then. And so the masses are kept worrying about, things that are irrelevant, and they don't unify and see that they haven't allowed an oligarchy to take over, and that's basically strip mining this economy, strip mining the working classes. I'm not a revolutionary. It's obvious what's happening. That's the way the system works. It doesn't, they can't even pass a law when everybody agrees that these people shouldn't be trading on inside information. How is it that all these Congress people and senators go to Congress and they're sterno bums, a lot of them? Some of them are already wealthy when they go there, but quite a few of them don't have two nickels to rub together, and they leave after 25, 30, 40 years there, and they have tens of millions of dollars on a salary of $174,000 a year. Well, they're trading on the information they have. They're trading on favors. That's what they do. And everybody knows it, and they don't care that you know it because there's nothing you can do about it. So this isn't the only reason that we're involved in Iraq. This is or Ukraine. This is just one reason. Okay, this is one constituency of many up there, but none of them are concerned about what you think or what your problems are, or the fact that the government should be trying to do the most for the people to make sure the welfare of the average person is increased over time. That's not what they do. They respond to their constituencies, and who gives them money is who they respond to. It's not a conspiracy. It's just the way it is. That's the way we've allowed it to degenerate into. And it's not going to change until it has a collapse. Again, I challenge anyone. A lot of people like to talk politics, I think mostly because they think it's fun. It's something to talk about. You're not going to vote your way out of this. Who are you going to send there that's going to make the changes? No one. If you go there even with good intentions, you get co-opted, and you just won't be included in anything. If you try to be, you can stand up there and give speeches when nobody's there, and they'll put it on C-SPAN at 12:30 a.m. and no one will watch it. No one will care. You'll be dubbed a crackpot. And eventually, if you get too cute, be like Senator Schumer says, they have 7 ways from Sunday of taking you out. Mr. Trump is finding that out now. Okay, that's it for this week, guys. Thanks a lot for your support. Again, if you're inclined to a subscription of the newsletter, prices will be going up September 1st from $150 to $179. If you get in now, you'll be grandfathered for at the same price that at the current price of $150 when your resubscription comes up. So take advantage of that if you're so inclined. And we'll talk to you next week. Thank you.